Hi, my beautiful people. I wanted to do a really small video on how to win in this market. So my personal view, compiling the data that I kind of look at, is that the market will go down. I'm expecting about a 20 to 30% correction in the market further still. So how do we play this market? Because it is kind of a little bit of a game, and how do we play it like a little bit with less risk? So I'm always risk averse, and I'm always trying to make sure like what is my upside maximum and downside maximum protection without losing too much, never losing capital. So I wanted to talk to you about a few strategies, and this, of course, what I'm talking about right now, and this video is meant for people who are a little bit more familiar with the financial markets, this is definitely not something that if you're a novice you would completely understand, but I'm hoping you just watch it to kind of get the language and the understanding of the markets. So you can stay in cash if you think the market's going down. Option 2 is you can short the market. And option 3 is something called doing reverse ETFs or reverse ETFs on the indices. So option 1 is the most conservative, staying in cash, which is like, hey, I think the market's going down, I've sold my positions, I'm staying a ton in cash. Option 2, which is buying puts or finding another way to short the market, is very aggressive, because it is meant for people who are very, very sophisticated, and even those of us who are very sophisticated tend to burn through premiums. While the returns are very good when you get it right, you almost, most of the time, you miss the timing of buying the puts. So that is something that I would say I don't want to talk about too much, because if you short the market through puts and you're shorting the market through other derivatives or other ways, you're very advanced. But I want to talk about something called buying reverse ETFs, which I don't think a lot of people talk about, and I really think that this is a wonderful, simple, no-brainer strategy. All it says is that if that index goes down, like a SPY, like a NASDAQ, or like Russell 2000, or the Dow Jones, every time it goes down, this index, this ETF, actually goes up. So it's kind of like, hey, that's kind of a no-brainer. If you know the market is somewhat going down, it makes sense to look at these reverse ETFs. A couple that I follow and I partake in, but please, you can do your research, do a little bit of Googling and find the ETFs that suit you. The ones that I play around in is the SQQQ, the SPXU, the SRTY. So those are the reverse ETFs that I play around in. There are multiple other ones, but those are the ones I'm most comfortable with. Again, the SQQQ is the NASDAQ reverse. So if you think the NASDAQ and the technology stocks have way more room to go down, that's a good place to be in. The SPXU is the reverse of the Spider or the SP 500 index, and the SRTY is the reverse of the Russell 2000 index. So let's just say the markets are coming down. These are a really good way to play the reverse. Like if the market comes down, these ETFs go up. So it's very relaxed. You're not timing the market. You're not kind of stressing out that your puts are expiring. It's like, yeah, okay. If I can see right things going up, I can write things going down. So it's as simple as that. I just think that's a great buffer for your portfolio. The last one I'm going to talk about is actually something called the UVXY. It's a volatility, it's a VIX index. So volatility in the market just means that the market does this. It doesn't necessarily go really up, doesn't necessarily mean it comes all the way down. It means that there is a lot of up and down movement. There are a lot of buyers and sellers, and so there's this like everybody has an opposing view, so there's a lot of volatility in the market. The one that I play a little bit in is called the UVXY. I played in a range bound trade. 11 to 12 is my buy, and I usually offload it about 15, 16. So that's a good 40-50% trading range. Am I always able to catch the bottom? No. And am I always able to catch the top? No. But I think that when you just kind of play that index, or this ETF, which is a volatility ETF, just in that trading range, I think it's a very simple sort of a, dummy proof, I kind of call it dummy proof way to play these markets that are very volatile. Do I think the market comes crashing down? I'm not sure. Do I think the market goes skyrocketing up? I don't think so either. But what I am sure about is that for the next 4 to 6 months, at least till October, November, till the elections in the US, the market may have a very bumpy ride, which means there's a lot of volatility in the market. So I think the best way that I have found personally in our portfolios and our investments is to be risk off in this sense. Don't be very aggressive with buying stocks right now. That's why in my previous video I just said 20% deployment at these prices. And the rest is a very good way to just say, you know what, I'm gonna play the volatility in this market, and that's it. I am not taking bets on individual companies going up or down. I'm just going to say, hey, there's volatility, the roadblocks are here, and volatility is the only thing that I can be assured of in this market, and so I'm just going to play that index, that ETF, and that's my very short, very sweet video for today, and I hope it helps you. Yes, please, I'm gonna put up a little picture on the reverse ETFs and sort of their trading ranges, so feel free to kind of track them, look at them, see if it suits you. I would always say use your own wisdom before mine, and I'm sure you're a lot wiser in so many ways than I will ever be. And yeah, on that note, toodles. I'm off on holiday, and see you soon.